In recent days, rising trade tensions between the US and China have sent shockwaves across the global economy. The spark? A series of sudden, high-stakes tariff announcements that have thrown markets into chaos. On April 2nd, the US declared a new round of Independence Day tariffs, an aggressive move that led to a stunning $3.1 trillion loss on Wall Street in just a single day. But that was merely the opening act. On the morning of April 4th, Beijing responded with force, unveiling retaliatory tariffs of 34% on key American goods, igniting a second market crash. Tensions that had simmered for years have now erupted into a full-fledged trade war between the world's two largest economies. As U.S. stock indexes once again close deep in the red, the world is asking a critical question. Where does this end? China has long criticized Washington's unilateral economic measures and repeated imposition of tariffs. The latest round of U.S. duties, some as high as 50%, spans nearly every sector and appears to be a direct attack on Chinese exports. Beijing didn't take long to strike back. Citing reciprocity, China's Ministry of Commerce announced its 34% tariff on American imports, targeting key industries. The impact was immediate and severe. Major sectors across the U.S. stock market tanked, triggering what analysts are calling a second bottom. Major outlets like CNN and The Washington Post led with headlines like, "U.S. markets plunge again as Wall Street reels from Beijing's blow." By the end of 2024, total trade between China and the U.S. had reached $660 billion, with $530 billion in Chinese exports to the U.S. and only $130 billion in U.S. exports heading to China. That imbalance, long a sore spot for Washington, has been the justification for aggressive tariffs. But China's latest response has placed new and unexpected barriers in the path of U.S. businesses. Key American exports, agriculture, automobiles, electronics, and machinery, now face massive surcharges that threaten to push Chinese buyers toward other suppliers. Experts have warned for months that such retaliation would severely impact the U.S. economy. American farmers, who ship billions in soybeans, pork, and corn to China, may now find themselves priced out of the market. This isn't unprecedented. During the 2018 to 2019 trade tensions, farmers were hit hard and only partially protected by government bailout programs. This time, the stakes are even higher and the losses potentially more widespread. The automotive industry is also in the crosshairs. U.S. manufacturers like GM, Ford, and Tesla either export directly to China or rely heavily on Chinese components. China's new tariffs will undercut the competitiveness of U.S.-built vehicles in one of the world's largest markets. Production cuts, layoffs, and price hikes may follow as profit margins shrink. Tesla, in particular, is already feeling the squeeze. Its stock has been tumbling amid growing uncertainty in the Chinese market, and the new 34% tariff will only make the road ahead more treacherous. The tech sector fares no better. China is a vital market and manufacturing hub for American tech companies. But with Beijing imposing new trade barriers and potentially restricting U.S. firms operating in China, global supply chains face severe disruption. On April 3rd and 4th, tech stocks experienced another sharp decline, reflecting widespread investor anxiety. So what's the price tag of these 34% tariffs? Many analysts estimate a $40 to $50 billion hit to U.S. exports, especially if Chinese buyers switch to alternate sources. And if this tit-for-tat strategy inspires others like Canada, the EU, or South Korea to retaliate as well, U.S. businesses could face even more pressure. This could snowball into market volatility, diminished profits, and a downgrade of national growth projections. For everyday Americans, the situation spells higher prices. The new tariffs mean imports will become more expensive. At the same time, American exporters are being locked out of a key global market. That's a dangerous combination. Falling income for producers, shrinking markets for manufacturers, and rising costs for consumers. Agricultural producers, automakers, and tech firms may all be forced to reduce output or cut jobs. Experts are calling it a lose-lose scenario, a historical echo of previous protectionist policies that only deepened economic pain. Beijing has made its stance crystal clear. If Washington escalates, China will match it. Chinese state media is broadcasting that any U.S. action will be met with equal retaliation. The agricultural and automotive industries are just the first battlegrounds. Reports suggest China is preparing massive stimulus packages to boost domestic consumption and cushion the fallout. As CNBC noted, China is already pivoting its trade networks toward Europe, Southeast Asia, and Africa, arguing that U.S. markets are too politically risky. If this trend continues, the U.S. could find itself increasingly isolated from the evolving global trade map. This conflict is making waves far beyond Washington and Beijing. European media outlets are warning of a global economic collision. Asian markets are reacting with uncertainty. Countries like Japan and South Korea are scrambling to determine how they fit into this rapidly shifting landscape. Though it may seem bilateral, this U.S.-China showdown is affecting the entire world due to the global nature of supply chains. From farming to high-tech manufacturing, logistics to energy, everyone is feeling the pressure. The phrase "second bottoming of Wall Street" is being used with increasing frequency, and some fear more shocks are on the way. Just 2 days after the first market crash, Beijing's announcement triggered another round of panic selling. With shares in Apple, Microsoft, GM, and Ford under intense pressure, fears of a prolonged economic conflict are rising. If this trade war drags on for months, a recession becomes a real possibility. Analysts across the board are issuing warnings. Protectionism might backfire, dragging the world economy into a deeper crisis. So why has China responded so aggressively? For years, Beijing has been frustrated with the U.S., accusing it of technology theft, intellectual property violations, and contributing to the trade deficit. After years of failed negotiations, the Trump administration imposed sweeping tariffs on April 2nd. Instead of replying with small retaliatory measures, China fired back with full force, signaling that it's done playing defense. This raises the stakes not only for Washington and Beijing, but also for U.S. allies. Nations like the EU, Canada, and Mexico may soon face the dilemma: pick a side or impose their own tariffs to protect local industries. While the total trade volume between the U.S. and China is $660 billion, it represents much more. It underpins entire supply chains and millions of jobs. A 34% tariff disrupts this delicate system, from corporate giants to small farms and factories. The central question now is, will this confrontation spiral further or return to the negotiating table? What terrifies markets most is uncertainty. Billions of dollars are vanishing from the markets daily, and panic selling could spread. China's hardline stance has rattled Wall Street twice in a matter of days. Officials suggest that retaliation was expected, but the severity is forcing some to ask, what are we gaining from this? If this strategy results in higher prices, lost jobs, and business closures, the White House could face mounting political backlash. Yet the administration frames this as defending American industry, a message aimed squarely at its base. Still, history reminds us that no one wins in a trade war. Analysts compare today's developments to the protectionist spirals of the 1930s, which worsened the Great Depression. In today's more globalized world, the impact of a similar collapse would be far more widespread. If U.S.-China tensions keep escalating, the world could see falling global trade, slashed growth forecasts, corporate bankruptcies, and mass layoffs. Other countries may follow suit with their own tariffs, creating a ripple effect that disrupts markets even further. As American stocks suffer their second major fall, all eyes are on the next move. Neither side appears ready to compromise, and if this standoff continues, a global lose-lose scenario may unfold. Companies will scramble to restructure supply chains, a process that's both expensive and time-consuming. Consumers will face rising costs, and manufacturers may be forced to cut back on production and jobs. If these trends persist, analysts warn of additional market drops, perhaps a third or even fourth bottoming out. This prolonged tension could even transform the foundations of global trade. Key sectors, electronics, automobiles, agriculture, and chemicals, are all at risk. The 34% tariffs are disrupting the flow of goods in both directions. And as the U.S. tries to absorb rising import costs, consumers will eventually feel it at the checkout line. Meanwhile, China is making U.S. goods more expensive at home, which may force buyers to switch to alternatives. Other nations may capitalize on the chaos, stepping in to grab market share. So we ask, how badly will these tariffs hurt the U.S. economy? Will falling profits and rising prices spark a public backlash? Could this bold move backfire on Independence Day? We'd love to hear your thoughts. Share your perspective in the comments, and don't forget to like and subscribe for real-time updates as this story unfolds.